All right, so the S&P got back to its winning ways on Mondays after breaking the streak last week while I was gone on vacation. It came back with a pretty good bang today. It was one of the better days it's had for a while. It's been pretty oversold the past few weeks, and we talked about it on Friday. We wouldn't be surprised if it rebounded, of course, today because that's what it does on Mondays, but also for the week. We're kind of expecting it'll be bullish. I mean, probably not every day this week, but it's probably going to end up with a bullish week this week and maybe even next week as well as we head into a new month. And seasonally a bullish time of year. The question is, for how long? I don't think it will be bullish the rest of this year. I think we'll just have a nice little rally to the upside here, only to falter again and eventually move down to lower lows. So we'll break that down again as kind of take a look at today's move and see how bullish it was, see whether or not it actually can produce a trend change. Because bullish trends start with one day to the upside, and so we'll see if today is that day. We'll take a look at what's driving a lot of the price action today. Kind of an interesting move. There's some patterns you wouldn't have expected. We'll look at those and what the implications of that are. And then our trade idea is a stock that's already kind of been on its own little pullback, and we'll see if we can't trade a bounce and maybe a breakdown. We'll take a look at how to do that. So let's go ahead and get started. Today is Monday, October the 30th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button right there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it really helps us out a lot, getting our content out to all of our followers on these platforms. That's why we always ask for it every day. Our goal is to get to 100. I've been in the 70s for the last I don't know how many videos, so let's see if we can get up there at triple digits. Again, thank you to those who do like it day after day, and those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're still in a bearish decline, intermediate line. The line, you got dark pink shading and a red line. Dark pink shading from the fact the intermediate line's bearish. It's rising, but it's well in the lower reversal zone. So remember, it doesn't matter what it's doing. If it's below the 20th percentile, you're always going to be bearish. The market sentiment, the red line comes from being below a falling moving average, right? So we're almost 3% below, still almost 3% below. We're still in the 16th percentile of the past year. It's one day, and it's a good day, as you'll see here, but it's definitely not a trend-changing day. We've talked about this before. We talk about this a lot, right? Anytime you're in a pullback, anytime you're in a correction, either way, you're going to have up days. In the correction, you're going to have up weeks. And we talked about the potential for this week is probably going to be an up week. It probably won't go up every single day, but it's probably going to be an up week this week, maybe even next week. So especially as I mentioned too on Friday, this is how far away from the moving average we are. We're still 3.7%. So that's, every time we get these bull tags, you tend to retest the moving average before you start to break down. In this case, you really retested it before you broke down. So you're probably going to retest this for a week or two up to the moving average. And then it's a matter of whether we get a bear tag and turn it around, which is unlikely, or whether we bounce back down like we saw both these instances back here in early 2022. Considering the intermediate line is currently below the moving average, or the market sentiment, on the weekly chart, you would expect that would be the case. We got one more day left in the month. Depending upon, we're right now 1.65%. So if we have a 2% up day tomorrow, then we can avoid this red line, right? This red line on this. This is a third month in a row that we've been down. It's not very common for us to get 3 months in a row to the downside. But we had 3 months in a row now, August, September, and October. The short-term sentiment, now the question here is how bearish is the short-term sentiment going to be? we are off the lows, 41.03, or about 60 points off the lows here. So that's helped keep short-term sentiment from being pretty bearish. But again, it's been like 50 years since the near-term line has been this low. So, depending upon how bullish we are tomorrow, we have a chance. We have a chance at keeping the line green, or at least yellow, and we have a chance at maybe not being so bad on this near-term line. But as of right now, it's looking pretty ominous, more ominous than what we've seen. Again, it's one thing. The last two times, which is like the 40s and the 70s, that we had the near-term line on the monthly chart this low, we were way below the moving average. This is an instance of getting it when we're just crossing the moving average, which sets us up for more of a sustained move below the moving average. Again, on a monthly chart, which means there's going to be lots of up days and lots of up weeks over the course of, and potentially an up month or two before and as we move lower. So that's what the market forecast is looking like. And remember the weekly chart again. Just kind of keep your eye on how much we do go up and how much the short-term sentiment improves as well. If you look at, like the Russell 2000, which has been more bearish than all the other indexes. Remember, it has had 14 clusters, a little bit of a Harami pattern. Again, we've seen this multiple Harami patterns before. So here's another one. Short-term sentiment's bouncing up, but again, not trend changing, at least not yet. So don't think just because we had an update today that it's 4,800. Let's get Tom Lee back on and let's raise our target back up to 4,800 by the end of the year. All right, if we take a look at the weekly chart here on the crossover, you'll notice again clearly below the 200-week or 40-week exponential moving average. So that's again sign of correction. When you're below this line, you're typically in correction. If I zoom out, you'll notice that when we're not below, especially when we got the pink shading, and we're in correction mode, right? And we are 0.42% percentage points away from getting pink shading. The first step to getting pink shading is this trading below. And you can see how close we were over here. If it wasn't for the Fed stepping in, we would probably be in bear market mode right now. But the Fed stepped in. We had the beginning of that over here, and then we got the intervention and the AI craze and helped push things up here for how many weeks in a row to the upside there with the Akinyashi candle. But every other time you get below the 200-week or 40-week, it's a proxy for our 200-day. But the 40-week exponential moving average, you can see that's when we get these corrections. So you got below it, then we got the death cross, and it got below it, and then the death cross, got below it, and the death cross, and that's what happens when you get these crossovers. So we are clearly below it right now, and you can see the candles aren't really that big. So if we're going to be more bearish, you can see there's probably a lot more weakness left to come, considering that we're not very bearish on the S&P. Of course, that's not the case on the Russell. The Russell has been plenty bearish here, and it continues to be. This is a pretty decent sized candle that we got last week. You can see it's about as big as some of these other correction sized candles. So we are clearly below there now and easily in death cross mode. 4%. The death cross there is widened out to 4%. Full on correction mode there, easy. In fact, like I said before, you could argue we are in bear market right now on the Russell 2000. 3 red arrows across the board here. If you go to the weekly chart, you got 3 red arrows there too on the S&P. If you look at the NASDAQ on the Qs, we have 3 red arrows here as well. And then of course on all the other indexes here, 3 red arrows across the board. So again, it's one thing to have 3 red arrows on the daily chart. It's another thing to have 3 red arrows and building on those 3 red arrows on the because again, you might get 3 red arrows, but if you bounce right back up, great. Like the last set of 3 red arrows that we had again back in March, but we didn't bounce right back up this go. And over here, the diamonds had March, and then over here in May we had 3 red arrows for 1 week, and then we bounced right back up. Right, similar to the daily chart, but again, we've had now multiple weeks. The diamonds the lines are red. The Russell, of course, the lines are red already. So you can kind of see how we are. Again, another sign that we are in correction mode, as much as maybe we don't want to believe that. Clearly below the 200-day moving average, holding support at the 62% retracement, the point of control as of now, bouncing back up. Of course, we're still easily below moving averages. So again, clearly not changing the trend as of yet. Not even close. The DMI is still bearish as well, but well above 30, barely above 10 down there, so easily below 20. The RSI and CCI are definitely not at bullish levels. They're still in bearish territory actually. So in fact, the weekly CSI continues to be very negative. It's got to at least get above 0 before you can even think about being bullish. We're nowhere near that. So it's going to be multiple weeks if we are indeed going to avoid, an actual correction here. And of course, like I said, I think we already are in one, so I don't think we are going to avoid it. In fact, if you look at the weekly Ichimoku cloud, we're actually still above the cloud, but you have a 26-week rate of change to the downside now. And what bullish trend we had on the weekly chart has gone, and you've actually got a weak bearish trend developed on the weekly chart. That's another indication that we are in correction there. We got intermediate trend strength going on the daily chart. Looking at the Bollinger Bands and the Keltner channel, we're still in the lowest quartile of the bandwidth. So again, definitely not trend changing. The bandwidth is rising and it's still relatively low. It's high relative to the last 150 days, but if you look over the past year, that 150-day high has been a lot higher. The momentum is still picking up to the downside. We got the green dots, so the bands are outside the Keltner channels. So we are, easily in bearish mode there. Today we did get a higher high and a higher low, kind of an equal low. Well, actually, it's kind of an anomaly there. It's probably a higher low. And then, of course, we closed up above yesterday's high point. And we're below the value area. So again, you can see kind of where we're probably, we can get up to 420 without skipping a beat. So that's probably where, if we're going to be bullish tomorrow, it's probably where we'll end up being bullish. Remember, this Monday formed the high of the day or high of the week or the low of the week. Pretty good chance we'll probably have formed the low of the week. We'll see. It would be a higher low compared to last week's low. So we'll see if this ends up being the high of the week or the low. I think we'll stay in this area for most of the week. Not very much of a range. Not bullish enough to get up and test kind of up here, but not bullish enough to really get into that upper half of the range. You can see we didn't get a new 4-week low point today, so that anomaly is not on the daily chart. So we didn't get a new 4-week low point, so we are down, but you got to have 6 days of not getting a new 4-week low point before we can think about being bullish. And this green line's got to get to 0, and it's a long ways away from that happening. Looking at the today's range and volume, you notice just a little bit below average volume, and the range was also below average. Again, not something you like to see on a when you're bouncing. I kind of want those first few bullish days of a new bullish trend to be pretty big too. Obviously, that's not the case, and the volume's rising, the ranges are rising, so that's bearish, and we still haven't even got to 1.5%, which is the peak, which is where we typically washed out with pullbacks, and if you typically get up to 2%, so that means like, depending upon how far down we go, that your ATR is going to be like in the 8 to 7 range. The ATR will get up into this area here, which means we're going to have some more bigger days if we are indeed, like I said, in correction where this price ratio gets, ATR to price ratio gets up to 2, which is typically what it does in correction modes. Volatility dropped big time today, dropped back below 20. It's just not a very volatile period. It hasn't been this whole time. We've been hovering around 95% relative to the VXV. That's not high. 100%, anything above 100% is where pullbacks get to. And if anything, this is a deep pullback. But like I said, most likely the beginning of a correction. That corrections, this gets up to like 115 to 125%. So we're nowhere near that. The VVIX is still at 95. So we're nowhere near a washout. Not even close to a washout on this. In fact, remember, we like to look at the relative ATR here with the VIX to see the range of the VIX, and it's picked up. It looks like it's at a high level. It's not. Let me look here. Let me zoom out, but on the daily chart, and you can see like that's still not a high. Like again, when you are in correction mode, you're up in here. You're getting the VIX moving up to like 15, 16. Even like this March one where we were quasi beginning a correction, we got up to 15. So we still haven't had a washout yet, not even close to having a washout. Like there was that was a deep pullback there in 2018, but there was the correction, and we were right around the high teens. COVID got up above 20. The beginning stage of this correction got into the 20s, and again we're still at 10. So we're still we're still in this mode where volatility is rising and trending higher. Right, we're trending. We're still above the 200-day. All these moving averages have crossed above it. We're getting a little bit of a downturn right now because we're going to probably be bullish this week. But we're not trend changing in any of this. Not even close. Not unless we really break like below 16 with a big move to the downside volatility, which of course most likely is not going to happen. All right, now let's take a look at what's driving this price action. You can see the 3-month returns. Again, not surprising because again we're in a correction, but today, we had been so bearish that today we had a little bit of a retown in risk appetite, and so you see equities above. In fact, even international equities, pretty much outpacing everything else. Real estate bouncing back up along with small caps. Small caps really lagging. They underperformed by about half of what the rest of even the international equities did. Of course, commodities were down big. That was one big reason. The dollar was down. That was another big reason. Yields were up slightly, but if you take a look at those charts for some of those assets, like the dollar and let's see if you take a look at the dollar first. Remember, it was down a little bit today, but again, not necessarily trend changing. But you can see we're in a convergence mode here. It's still in, and I don't know why it does this here. You can't really see that PPO very well, but if I do this, you can see it better. We're in this convergence mode right now. Doesn't mean we have to roll over, but at least as of right now, we're in this convergence mode, and we'll see if we actually go negative or if it just turns back to being positive, which I expected that would probably most likely be the case. If you take a look at the 10-year yield, there we go. Sorry about that. We got the 10-year yield. See, it's also in convergence mode. MACD is coming down, but we're still above the 17-day moving average, so we're still okay, right? But we're in convergence mode. That's one big reason why things are not so bearish here. But you look at commodities. I mean, that's the other reason. But commodities have kind of shifted towards causing a lot of the weakness that we've seen since July 31st, being one of the culprits for it, to now kind of falling along with equities, which is kind of typical. The crude oil is typically kind of positively associated with it. But you notice it's only come down to the top of the value area. So, it had ramped up so much that we're just kind of in pullback mode here, still above the 200-day moving average. But, we'll see if it ultimately ends up bouncing back off of this pullback low point. I think ultimately that's what's going to be the case. So you'll have a bounce up in commodities, a bounce back up in yields, and that three-headed monster kind of being what's really putting a lot of pressure on this equity market right now, at least over the past couple of years, when there has been weakness in equities. When you take a look at today's breadth, remember the Russell 2000 really underperformed. That's usually a sign that breadth is pretty poor, and you see that we're still negative. Like we're not as bad. We're not as bad as we were, but we're still negative there on the breadth. On a good day like this, you'd like to see a big jump up in the number of stocks above the 50-day moving average. And it was a pretty decent jump up, but it didn't get above, the moving average. It didn't even get close to moving average there. So that's, of course, the number of stocks above the 200-day moving average still easily below 150. Looking at the new highs and new lows for the day, it's still way down in negative levels. So again, the breadth is nice rally today, but the breadth was very poor. The money flow was obviously pretty poor as well. As you notice down here, it's still in negative levels. It bounced back up, but still easily in bearish levels here. So nowhere near, a rebound. So it's nice. And rebounds start with one day, but usually they start with better days than this. Again, you like to see, a bigger gap to the upside, you can see it started off as a pretty decent gap, but we filled in some of it and we didn't finish with like a 2% gain to the upside. So wasn't quite like the runaway gap that usually starts these kind of moves. If you take a look at the sector rotation, you can see, it was really those three sectors, communication services, consumer discretionary, technology, communication services did the best. Those two are okay. They were up today, lagging a little bit. Staples continues to be a very strong outperformer. Utilities lagging behind as well. Energy and real estate. So it's kind of interesting because those two usually have been on opposite ends. They ended up both lagging there, and that's not surprising. Crude oil's down, energy is going to lag. It is a little surprising that real estate didn't do as well. So, and for that matter, that technology didn't do as well. Semiconductors really didn't, kind of suffering here on a relative basis. Remember, that's the rotation that we're getting. When you look at the rotation among sectors, staples and utilities are still your strong momentum to the upside. Financials and materials are moving up to the upside. Technology, communication services are moving down to the left. So there's a clear rotation, not just on the daily chart here. Remember the weekly, there's communication services and technology are gaining some momentum and are still on the positive side of relative strength. That's not the case for discretionary, and you can see utilities and staples. In fact, the three biggest momentum right now on the long-term basis are utilities, healthcare, and energy. So we're rotating slowly out of these three areas, which had been your better performers, and they're slowly working their way out. Even energy is coming down, and it's really kind of a safety mode. And usually real estate's kind of up there too, but that's not even up there. It's financials, it's materials. There's healthcare that's usually kind of a safe haven trade, and it's got pretty decent relative strength, but it's lacking in the momentum right now. There's clearly the momentum in these two areas of safety, and then energy as kind of a lagging sector that does really well at the during corrections. All right, now let's take a look at our trade idea of the day. Let's take a look at CrowdStrike. You can see it's been in a bullish trend, but you got the bull tag. You're at the pullback right here, right down to the moving average. Intermediate line is bearish, but that's not a very strong bearish move. It did cross below the market sentiment, but you can see the near-term line's already coming back up. Not surprising, a lot of stocks. That's the case today. You look at the weekly chart for CrowdStrike, and you see, okay, it's again, it's been bullish. Give it a second here. It's been bullish. Now we have some transition, but we're not really breaking down. You can see we haven't really closed below some of these candles, and we don't have a red arrow, so we don't have the close below the 10-week moving average. We don't have that yet either. It's a very weak bearish candle, so nothing too major. You're close to 3 red arrows because you're sitting right on the moving average there. MACD is negative, but it's right at 0. The histogram's already turning up a little bit there. Stochastics is in bearish territory, but nothing too extreme. You're still well above the value area, as you can see, above the value area, well above the 50-day moving average. So, it's not even really a pullback. It's a really weak pullback. Getting below the 50-day moving average to the 200, that's where you get pullbacks, right? So that's nothing too major there yet. If you look at the DMI, here, again, both lines are below 25. In fact, the positive is below 20 slightly. So no trend. We had a bullish trend. Now we're at a situation where we don't have a trend at all. And if you look at RSI and CCI, that's kind of the same way too. The RSI is right in the middle of the chart. It's not in bullish levels, but it's not in bearish either. It didn't drop below 40. We did drop below kind of this minus 100 level, but we're already turning back up. We'll see how far that ends up going. The Ichimoku cloud, when you take a look at that, we are above the cloud. We pulled back to the blue line. We're a little bit below that. We lost the bullish trend that we had, but we're still above the cloud. We still have a positive rate of change. Again, nothing too major there. Oops. If you take a look at the Bollinger Bands and the Keltner channel, so we'll pull that up here. You'll notice that we are, the Bollinger Band width is getting smaller. We're right smack dab in the middle of it, a little bit below the midpoint, but smack dab in the middle of it. And you can see the bands are outside the Keltner channels, but they're moving towards them, as we just saw here. And the momentum has really gone negative. So you're really close to getting some red dots again on the stock. So what I decided to do on this was to come out and do an iron condor spread right at the low 20 deltas on both sides, selling both of those low 20 deltas, buying 10. In this case, I have to go $10 away, so I'll do the same on the put side. That gives me this iron condor, and with those, you can see those break evens, where those break evens end up being. The low point ends up being, the low break even here ends up being right around that point of control, a little bit above the 200-day, good support, right where I want it to be. The upper break even allows it to bounce back up potentially to new highs, and we'd still be okay for December expiration. So that's the trade that we put on. We position size for not fully, it's about 2/3 of normal because it's a $10 wide spread. But I end up getting a good reward that I normally would get for a full risk here. I'm getting for only 2/3 of a risk. So we're able to take advantage of the of the volatility right now in the stock to be able to see if we'll stay in this range with earnings coming up after November expiration. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.